The biggest scam in modern finance isn't crypto and it isn't meme stocks. It isn't some anonymous guy in a group chat promising to triple your money by Friday. The most brilliant scam in finance is hiding in plain sight inside the account you were told was the safe, responsible choice. It's the ETF, and by the end of this video, you're going to see your own portfolio completely differently. Stay with me because once you see this, you genuinely can't unsee it. My name is Marcos, and I've spent years obsessed with one question. How does the financial industry quietly take money from people who did everything right? Most channels will tell you ETFs are perfect, that you just buy, hold, and never think again. They're half right, and that half-truth is exactly what makes this so dangerous. Because there are really two kinds of ETFs, and this entire industry depends on you confusing them. One kind quietly builds your wealth, the other quietly drains it, and they sit on the very same shelf. Telling them apart is the single most profitable skill in all of personal investing. If you want to see how money really moves, the mechanics nobody bothers to explain, watch this video until the end, because this changes how you read every fund you'll ever own. Right now, there are more ETFs in the United States than there are actual companies you can buy on the stock market. Stop and let that land for a second. There are over 4,800 ETFs and fewer than 4,300 listed stocks for them to even hold. Think about how strange that is. We built more boxes than we have things to put in them. It's like walking into a restaurant with 4,000 dishes, then learning they're all made from the same 50 vegetables, same ingredients, wildly different prices, and a waiter constantly pushing you toward the most expensive plate. And somebody is getting very, very rich off all 4,000 of those menus. Each one of those funds is a toll booth, and every year you stay invested, it quietly takes its cut. You feel safe because the word diversified sounds like a fortress with thick stone walls. You picture your money spread across hundreds of companies, protected, untouchable, working while you sleep. It's a comforting picture, and most of it is even true. But here's the part that most people completely miss, and it might be the single most important point in this entire video. The ETF wrapper itself is genuinely brilliant, one of the best inventions in the history of investing. The scam isn't the wrapper. The scam is what they stuff inside it, and what they quietly charge you to hold it. And to understand that, you have to follow the one thing nobody wants you to follow: the money trail. Now let's talk about the number they pray you never actually sit down and calculate. Every ETF charges what's called an expense ratio, always shown as a tiny, harmless-looking little percentage. 0.75%, 0.75%, sounds like a rounding error you could ignore forever. Your brain hears less than 1% and instantly files it under doesn't matter. That reflex, that little shrug, is exactly what the entire industry is quietly counting on. Because a fee this small feels impossible to take seriously, and that is the entire trick. So let me show you what that harmless little fee actually does over a single lifetime. Picture investing $10,000, leaving it completely untouched for 30 years, earning a steady 8% a year. In a rock-bottom index ETF charging just 0.03%, you walk away with about $99,791. In a fund charging that tiny 0.75%, you walk away with roughly $81,643 instead. Same market, same companies, same 30 years. The only difference is the fee they quietly skimmed. That single invisible decision made just once quietly cost you $18,148. That's more than 18% of your entire profit gone, and you never saw one charge on one statement. But here's where it gets worse, and this is the part that will probably surprise you. Because most people don't invest just once, they invest every single month for decades. Put away $500 a month for 30 years, and that same small fee devours nearly $100,000. $99,710 to be exact, transferred from your future straight into a company's revenue line, one fraction at a time. That's a paid-off house, a child's education, years of your own life, handed over for nothing. And the cruelest part is how it works. The fee compounds against you, the same way returns compound for you. Every dollar it takes today is a dollar that can never grow into $10 tomorrow. This fee isn't a boulder crushing you all at once. It's a slow, silent leak you never hear. And a slow leak, given enough time, will empty the entire tank while you sleep soundly, and nobody ever mails you a bill because it's skimmed off the top before you see it. Now here's the twist on the fee itself, and it's almost insulting once you notice it. The cheap, honest funds barely advertise, while the expensive ones flood your feed with beautiful, confident marketing. Think about what that tells you. If a product were truly the best deal, it wouldn't need a marketing budget at all. The loudest fund in the room is almost never the one quietly making you rich. Now here's where things get really interesting, and where the psychology quietly takes over. The cheapest, best ETFs are boring, and boring, unfortunately, just doesn't sell. So the industry built a machine to sell something far more addictive than diversification. A great story. Think about every trendy ETF you've seen advertised in the last couple of years. Artificial intelligence, robotics, space exploration, clean energy, cybersecurity, each one wrapped in a shiny promise. Every single one sounds like the obvious future, and that is exactly why it's so dangerous. They're not selling you a portfolio. They're selling you the feeling that you're early to the future. There's a psychological trap at work here, and it's called narrative bias. Your brain craves a vivid, exciting story far more than it craves a boring, sensible spreadsheet. A fund called disruptive innovation feels smarter than a fund called total market, even when the boring one quietly wins. And here's the brutal timing problem nobody ever mentions about these theme funds. They tend to launch right after a trend has already exploded, selling you yesterday's excitement at tomorrow's premium. By the time a trend is famous enough to become a fund, the easy money is usually long gone. You buy the story at the very top, right as the smart money is quietly slipping out the back door. Meanwhile, these story funds charge you 2, 3, sometimes 10 times more for the simple privilege of believing it. Let me make it concrete because this is where it really hits home. Picture two investors. Same salary, same city, same starting balance, same paycheck every 2 weeks. The first buys the exciting thematic fund and checks it obsessively, feeling brilliant on every green day. He pays high fees, trades constantly, and feels like a genius right up until he suddenly isn't. The second buys one boring index fund and genuinely forgets the password to her account. 10 years later, the boring investor is quietly, dramatically ahead, and she never once felt clever. But here's where most people mess this up, and honestly, I see it constantly. There's an even sneakier trick the industry plays, and it's called closet indexing. You pay high active style fees for a fund that secretly just hugs the index it claims to beat. You're paying steak prices for a kitchen that's quietly serving you the exact same ground beef. So you start asking yourself a dangerous little question. Wait, what am I actually paying for here? And that question right there is the one they built an entire industry to keep you from ever asking. So here's the twist that flips this entire video on its head. Remember the title, A Brilliant Scam, and I meant the word brilliant completely sincerely. Because hidden inside this ocean of overpriced products are a tiny handful of ETFs, so good they're almost unfair. A few broad index funds let an ordinary person with no degree and no expensive terminal own thousands of companies at once. For about $3 a year on every $10,000 you invest, you get diversification once reserved only for the ultra-wealthy. And this is the part that nobody in the finance industry will ever say out loud. With those few honest funds, you aren't the one being scammed. You're the one running the scam on Wall Street. That sounds arrogant until you realize the math has been quietly on your side the whole time. You quietly capture nearly the market's entire return while an army of analysts in expensive suits tries and fails to beat you. You do it in your pajamas, on your phone, paying almost nothing, and you still come out ahead. No genius required, no crystal ball, no stress, just patience and a brilliantly cheap wrapper. So how does a giant industry survive selling a product that good and that cheap? Simple. They bury the three genuinely great ETFs underneath 4,000 mediocre ones. For every honest low-cost fund, they manufacture 100 forgettable ones built mainly to generate fees. They drown the signal in noise until you honestly can't tell the foundation from the gimmick. They make the brilliant choice and the terrible choice look like harmless cousins on the very same shelf. The entire game depends on a single thing: you not knowing which is which. Think of those few core funds as the foundation of a house, plain, unglamorous, and absolutely load-bearing. Get the foundation right, and almost everything else in your financial life gets quietly easier. Everything else they try to sell you is just expensive decoration nailed onto someone else's wall. This isn't my opinion or some hot take. It's 2 full decades of cold public data. The people who run the industry know this perfectly well. They just quietly hope that you don't. So let me hand you a number that makes the foundation impossible to ignore. For over 20 years, an independent scorecard called SPIVA has tracked the professionals against one simple index. The result is so lopsided that it almost sounds like a typo. Over any 15-year stretch, roughly 90% of professional fund managers fail to beat the basic S&P 500. Let that sink in. 9 out of 10 experts, beaten by a fund that simply buys everything. Stretch that out to 20 years, and about 92% of them lose to the boring index. These are people with research teams, insider access, and 7-figure salaries, losing to a fund a teenager could buy. And the rare manager who does win one decade almost never manages to repeat it in the next. The scoreboard is brutal, and it has stayed brutal across booms, crashes, and everything in between. Now here's where the math gets genuinely dangerous. In the corner of the ETF world people treat like a casino, there's a category called leveraged ETFs, promising you 2 or even 3 times the daily move of the market. They sound like a cheat code, and they quietly destroy people who don't fully understand them. Watch this carefully because the entire trap is hidden inside the math. Say the market drops 10% one day, then rises about 11% the next, landing right back where it started. You broke even, 0 loss, nothing gained, nothing lost. But a 3 times daily fund falls 30%, then rises 33%. And instead of breaking even, you're down 6.67%. Hold one of these through a choppy sideways year, and the decay can quietly bleed you dry. The market went absolutely nowhere, and you still lost money, purely from how these funds reset every single day. Regulators literally warn, in writing, that you can lose money in these even when the index you bet on goes up. That's not investing. That's a slot machine wearing the convincing costume of an ETF. And these are the exact products plastered all over social media as the fast lane to getting rich. For most people who hold them too long, they're really the fast lane to losing it. Here's a number that should stop you cold. Most of those thousands of funds will never even survive. The industry quietly shuts down or merges the losers, so the failures vanish from the public record. You only ever see the survivors, which makes the whole menu look far smarter than it truly is. The proof is everywhere, sitting in plain sight, the moment you finally know where to look. So here's what actually changes the moment you truly see all of this. This was never really about funds. It was always about who you become as an investor. You stop being the person who buys the exciting story and become the person who reads the boring holdings. You stop asking what's hot right now and start asking, what is this quietly costing me? You feel a strange, steady calm while everyone around you chases the next shiny. You sleep better because your wealth isn't riding on a fragile narrative that can collapse overnight. And that calm compounds, exactly like the money does, a snowball rolling downhill, gathering speed for decades. The boring investor wins slowly, then suddenly, and almost nobody notices until it's already done. It starts small, almost invisibly, with one honest question about one single fund you already own. Then it spreads until you're reading every fee, every label, every quiet promise with clear eyes. You stop chasing and you start owning, and the difference between those 2 words is enormous. Chasing keeps you anxious, exhausted, and broke. Owning finally lets you exhale. One path feels exciting and ends in regret. The other feels dull and ends in freedom. The person who learns to ignore the noise doesn't just keep more money. They become far harder to fool in markets, in business, and in nearly every other part of life. Clear eyes about money tend to give you clearer eyes about almost everything else. And the wealthiest people you'll ever meet built it through patience that looked painfully boring from the outside. Boring, it turns out, is the most underrated superpower in all of investing. That's the real return, and it's the one thing they will never print in the brochure. So let's go all the way back to where we first started. The ETF was never the villain, and it was never the hero. It's a brilliant tool wrapped around a brilliant scam, and the only thing between them is whether you bother to look. The fees, the stories, the leverage, all of it only works on the investor who never checks under the hood. So start today, right now, before this video even finishes echoing in your head. Open your accounts, find the expense ratio on every fund you own, and ask what story you've quietly been paying for. Because the moment you start looking, the scam stops working, and you become the type of investor it was never built to beat. You stop being the product, and you finally start being the owner. If this changed how you see your own portfolio, watch the next one. I break down the exact way you should start thinking about saving. I'll see you there.